most, if not everybody on. Uh, so I'd like to thank you for attending. This is Timeless Truths for Investing, and we have a special guest with us today. I'll introduce him in just a moment. Many of you know who I am, but for those of you I've yet to meet, my name is Joe Bilello, CEO and founder of Avanti Wealth Management. My team and I have been helping clients gain clarity um, and confidence in their planning and investments decisions for over 30 years. So tonight, we're honored to have Jason Muir, co-founder and managing partner of Eventide Asset Management Funds, to reflect on the collected wisdom of nearly 150 years of investing. He looks good for his age, though. And I'm excited for him to share timeless truths that align with how we approach investing here at Avanti. Those of you who are already part of our Avanti Wealth family might recognize Eventide and the value that they've added not only to your portfolios, but also to the world in which we live. As a reminder, for compliance purposes, this webinar is educational in nature and not a recommendation to buy or sell a security there. That should make the compliance people happy. Also, throughout the presentation, if you have any questions, you can type them in the Q&A box at the bottom of your screen. And following the presentation, we'll answer as many as we can. With that, let me turn it over to Jason.
Well, thanks, Joe. That was a great intro. I love that story. I just want to say a warm hello to all of you that are joining. I grew up in Florida, in Ocala, and so I have a special heart for Floridians. I'm delighted to get to do this with you. As Joe said, we're talking about the timeless truths for investing. This is not going to be a product pitch in any way. This is to help you become a better investor. All right, so let's dive in. I'm Jason. Good to meet you. I'm a managing partner of a company called Eventide. We're a mutual fund company that's based in Boston. We specialize in values-based investing. We work with Joe. We have for many years. My day-to-day work is in an area of advocacy where I'm an advocate for considering your values whenever you make investment decisions. All right, so let's dive in here. So I created this presentation back in March of 2020. And we all know what was happening back then. The world changed. We had this new virus. We were seeing an exponential rise in cases. We didn't know what we were up against. We saw the way that it hit the economy. Things started closing down. People stopped traveling. Gyms were closing. Churches were closing, et cetera. This upset the stock market. There was a big dramatic sell-off, the fastest fall in history. And everybody was really concerned about what to do with their investments. So we made this presentation. Since then, of course, we had a summer. Last summer was, there was a lot of social unrest around social justice issues. Then we had an election that everybody was really anxious about, feeling like the fate of the world hung in the balance. We had a transition of power. There's always things. Now we're talking about how the market is very expensive and due for a correction. There's always things that will cause us to say, what do we do with our investments? And I just want you to know that these situations will come up over and over and over again. But there's a constant way to deal with all of them. And that is to focus on the classics, the timeless truths for investing. And this is the greatest hits of the last 150 years of investing wisdom that we've collected. I've got 5 points. I'm going to put them up on the screen. We'll talk about each one in turn. Number 1, keep your eye on the owner, not the dog. Number 2, restrain yourself. Number 3, employ a system that forces you to buy low. Number 4, remember the most powerful force in the universe. And number 5, invest in businesses, not stocks. All right, let's start with the first one. Keep your eye on the owner, not the dog. What in the world? Well, it comes from one of my favorite quotes, which was said by Ralph Wenger, who was a successful portfolio manager over a fund called the Acorn Fund. He has a very, very memorable illustration about the investing markets and how they work. So I want you to check this out. He says this. He likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. Can you picture it? The dog's owner, the person who's walking this dog, is walking from Columbus Circle through Central Park to the Metropolitan Museum. Now, at any one moment, there's no predicting which way this pooch is going to lurch. But in the long run, you know, right? The dog is moving northeast at an average speed of 3 miles per hour. What is astonishing is that almost all the market players, big and small, seem to have their eye on the dog and not on the owner. Hopefully, this metaphor makes a little bit of sense to you, but I'm going to make it very plain by looking at this chart. What we're looking at here is the entire history of investing in the US stock market, going all the way back to 1871. The blue line is the stock market performance with all of its ups and downs. In the metaphor, this is the excitable dog on the long leash in New York City, darting randomly in every direction. There's really no predicting which way the dog is going to lurch. Similarly, there's no predicting which way the market is going to lurch. So that's that metaphor. Now, who's the owner? The owner is the yellow line here. This yellow line is the best fit line for the data. And you can see it's a pretty good fit. This is a straight line. There's no curvature to it at all. And what do you see? If you just look at 150 years of investing in the US, what do you see? The market has gone up and to the right. This is the reason that people invest their money over long periods of time. The experience in investing has been remarkably predictable. It has been a move up and to the right for 150 years. And in investing terms, that constant rate of growth has been a constant 6.6% growth. So what is the lesson here? When you invest, what is going to happen is you are going to be reading the news and you're going to hear about this dramatic sell-off in the market, or the market is ripping and doing so well. And your emotions are going to rise and fall. But what do you need to do? You need to keep your eye on that yellow line, the owner, that long-term trend in investing. That's the reason you're investing. So don't lose sight of the big picture. All right, number 2, you have to restrain yourself. This is going to get a little personal, but we have to reckon with the enemy within. We are often the biggest barrier to investing success. And I want to talk about this. So let's do a little introspection together. I want to show you this article from the Wall Street Journal. This is going back a ways. You can see December 31, 2009. Every decade, there is crowned some new king of mutual funds, depending on whichever fund puts up the best performance track record for the decade. So you can see this is right at the close of the decade of the 2000s. And this is the coronation ceremony for the king of mutual funds over that decade. You can see best stock fund of the decade. It was this fund called CGM Focus. Coincidentally, this fund operates in my same building. You can see here in the opening paragraph, this fund put up an impressive 18% annual return. Now, if you're not used to hearing about annual returns, what that means is 18% return per year for 10 years. Just killed it. Now, the question is this, and I've got a poll on this. I'm actually going to put this up on the screen. I'll let Joe answer this too if he wants. What do you think the investors in that fund earned as their return for this very decade? Did they get that full 18% per year return? Or did they get something less? And I've given you a number of choices here. So the best fund of the decade was this fund. It got 18% per year. How did the investors in that fund do? Did they get that same return or something less? What do you think? Good. You guys are taking to this. Very good. I'll leave this open a moment longer. Okay, I'm going to call it done. We'll look at the results together. So no one said they got the 18% return per year. We had a few answers for 12% per year. Majority answer said 9, a few for 2, and a few even for negative 11. Let's look at the right answer. So the article continues. Too bad investors weren't around to enjoy much of those gains. The typical CGM focused shareholder lost 11% annually, meaning they lost 11% per year for 10 years. Okay, now wrap your mind around this. This is the very best investment you could have chosen, 18% per year return. The investors in that very fund are losing 11% per year on average. What in the world, right? What's happening here? Well, the article explains. These investor returns, also known as dollar-weighted returns, incorporate the effect of cash flowing in and out of the fund as shareholders buy and sell. Investor returns can be lower than mutual fund total returns because shareholders often buy a fund after it's had a strong run and sell it as it hits the bottom. Here's what's happening. People are shopping for a fund. They're shopping for an investment. They want a good one. They find this fund. They say, wow, look at the return on this thing. So they buy it after it's had a strong run. So they're buying it when it's expensive. The fund will experience a downturn. All funds have downturns, but they'll make a mistake. They'll sell it after it's sold off. So they bought high, sold low. Lo and behold, the fund will recover. It'll put on an impressive streak of performance. It will attract a new set of investors who will buy it at a high, sell it at a low. This happens over and over and over again. Investors make all of the classic mistakes in investing. They chase a hot return, buy something when it's expensive. They give up in the hard times, locking in a loss, and this ruins the investor return experience. Let's go further here. This is a book on psychology written by a person named Daniel Kahneman. You can see he's a Nobel Prize winner in economics. This book has been passed around a lot in my industry. I don't know if you've heard of it. I'll save you the trouble of reading it if you can just get this quote, which is from page 1. The premise of this book is that it is easier to recognize other people's mistakes than your own. Isn't that true in life? It is very true in investing. And here's how I would say it. Isn't it easy for us to look at that example of the CGM focused shareholders and to say, oh, those fools, but not me. I wouldn't make those mistakes. I would have stuck it out and enjoyed the full return. Would you have? I want to now broaden our look. So we looked at the investors in one fund. I want to now look at the investors in all funds. Show you the results here. So what we're looking at is 20 years of history, 96 through 2015. We're looking at the returns of various investments. Okay, so the best performing investment over that 20 years was in a real estate investment trust. This is a real estate investment. It got 10.9% as a category per year. Next was the S&P 500. It got 8.2% per year for 20 years. This is a 60-40 mix of stocks and bonds, a 40-60 mix of stocks and bonds. Bonds themselves, gold, this is emerging markets, the sale of our homes, the performance of oil, the rate of inflation. And look at this. Dead last is the average investor. The average investor underperformed every possible investment they could have made in that 20 years. And you can see failing even to keep up with the rate of inflation, which means that in real terms, they lost money. Now, aren't these investors owning these very investments? Well, yes, they are. So why are they failing to earn the same returns? It is for the exact same reason that we saw the CGM focused shareholders. Investors love to chase a hot return and to give up in the hard times. We do it all the time. And this, on average, ruins our experience. This is all investors and all mutual funds. This is a very broad picture here. So the lesson here is that we are often our own worst enemy. Our problems are often not with the fund we're investing in, it's with us, the investor. I love this quote from Morgan Housel, who says that finance would be better if it was taught by the psychology and history departments at universities. Couldn't agree more. And I love this quote from Jesse Livermore, legend from way back, who says the big money in investing is not in the buying or the selling, but in the sitting. Do you know what we should try to be telling ourselves whenever we invest? It shouldn't be when's the right time to buy, when's the right time to sell. It should be, how do I sit here and do nothing? That's the right mentality. All right, number 3, employ a system that forces you to buy low. So we talked about what we don't want to do, right? We don't want to be buying something when it's expensive and selling it at a lower price. We want to do the opposite. We want to buy things when they're less expensive, sell them for a higher price later. There's actually a systematic way that you can do this, and I want to introduce it to you with an experiment. And this is going to be an opportunity for another poll, so please pay attention. The experiment is this. I want you to imagine with me that we were dropped into history somewhere between the year 1920 and 1979. So we could land in 1920, we could land in 1925, 37, etc. We don't know where we're going to land. We just are going to be dropped into history somewhere. And our task is that we have to invest in the US stock market for the next 40 years, no matter where we land. Okay? That's our experiment. Now, I'm going to give you a choice between two investment strategies. Option one is no matter where you land, you got to stick with it. You invest $100 a month. That's option one. Option two is you save up $100 a month, keeping cash on the sidelines, and you wait for the market to dip. And whenever the market dips, that's when you buy. So like last March 2020, when the market crashed, you buy it then. Now, I'm going to sweeten the deal on option two. I'm going to grant you perfect knowledge of the future so that you'll know exactly when these corrections are, and you'll be guaranteed to be able to buy the market at these absolute rock bottom prices whenever it sells off. Question is, which would you choose? Let's say this is a real experiment, okay? I'm going to put up a poll to gauge your answers. Option one, again, is investing $100 a month. Option two is saving up $100 a month and buying these dips in the market, and you know exactly when they'll occur. What do you pick? Great. Thanks for participating. All right, last call. See how you did. All right, so 100% of the audience said they would take option one. And this actually happens almost every time because this just seems so preposterous, right? How could option two not be a slam dunk? I mean, you just save up all your pennies, you know when the market's going to crash, and you invest everything on the perfect day. How could that not be a slam dunk? And option one just seems so unlikely. So unlikely, in fact, that it's got to be the right answer. That's kind of the thought process. Well, someone actually conducted this experiment. They tried every 40-year scenario, both strategies, and they graphed it. I want to show you what that looks like and explain it. So here are the results. When this blue line is above the horizontal dotted line, what that means is that that was a period of time in history where choosing option two, that buy the dip strategy, was the better choice. So if you landed in the 20s, buy the dips was the better choice. And again, in the late 30s, early 40s, buy the dips was the better choice. That was option two. When the blue line goes below the horizontal dotted line, what that means is that option one, investing $100 a month, was the better choice to make. Now, you can see which one is the odds-on favorite. It is option one. 70% of the time, this $100 a month strategy outperforms, which is pretty impressive, 70%. But keep in mind that I gave a huge advantage to option two, that perfect knowledge of the future, which of course none of us have. I have no idea what's going to happen in the market this year. And I'm sure Joe would be guessing as well. We don't have that knowledge of the future. So let's assume we don't get it perfect. Let's assume we miss time buying the dips by just 2 months, which is pretty reasonable, I think. And you recrunch the numbers. Then option one outperforms 97% of the time, virtually the entire time. Now, how can this be? Why is this boring strategy working so well? Well, it's called dollar cost averaging, and it's very simple. It's the practice of investing a fixed amount of money at regular intervals over time. So just $100 a month is a great example. The dollar amount can change, the frequency can change, but it's that regular automatic investing. I'm going to show you on a graph why it works, but here's the verbal explanation. When you do this, the strategy will naturally buy more shares of an investment, any investment, when prices are low, and it will purchase less shares of an investment when prices are high, which is exactly what you're trying to do. Let me show it to you. So this is the period of the 2000s. This is the S&P 500. This is a decade of performance. You can see the market crashed twice. This second one here was the financial crisis. The market ended the decade down 24%. It's called the lost decade in investing as a result. Many people say the hardest decade to invest in history. Now, how did dollar cost averaging do? Let's take a look. So on the top, you see the same thing. That's just the stock market performance. On the bottom in the green, what we're looking at is how many shares of an investment you're able to pick up doing this dollar cost averaging monthly technique. Okay, so I'll walk you through it. Here at the beginning of the decade, what do we see? The market is at a high. Prices are at a high. So when you make your fixed monthly purchase, you're only able to pick up, in this example, 3.5 shares. The market then begins to sell off. So as you make your fixed purchases every month, prices are getting cheaper, your money's going farther. So you're able to buy more and more and more shares. The market then recovers, your money starts to not go as far, the market crashes, you're able to buy more shares, so on and so forth. Hopefully you can see the way this is working. Now, if you just kind of step back from the screen and compare the blue line and the green line, do you notice anything? Do you notice that this dollar cost averaging technique is in fact a buy the dips strategy in disguise? Do you see it? Do you see how the green line is peaking right when the market is making a trough? Look at the second one. Talk about impeccable timing, right? Now, of course, you weren't trying to time the market. All you're doing is you've got to set it and forget it, automatic investment plan. It's built into the mechanism. This dollar cost averaging will purchase nearly twice as many shares at low prices than at high prices, which is great. And just through this smart buying technique, your return for the decade would have been plus 5.9%, much better than minus 24%. This is an unusual quote for an investing presentation. This is from Napoleon Bonaparte. This was his definition of military genius. I like it for investing genius. He said this: the man who can do the average thing when all those around him are going crazy. If you just set up a monthly investment plan, I will admit it's very boring. It is doing the average thing. But it turns out that in investing, much like in war, according to Napoleon Bonaparte, being the average person and doing the average thing is actually the smartest thing to do. So just, I would encourage you to set up an automatic investment plan if you're not already doing it. All right, number 4, remember the most powerful force in the universe. Believe it or not, Albert Einstein once said this: the most powerful force in the universe is compound interest. How about that? Compound interest is an investing force. So why would a person like Einstein be so impressed with an investing thing? I'm going to talk about that. And we're going to use a very classic example. This is called a very expensive cup of coffee. So the average price for a cup of coffee when you go to a coffee shop is $3. That's the national average. If instead of buying $3 in coffee per day, what happens if you just invested that amount of money? How much would you have after 40 years? Well, if we assume the historical growth rate from the first example of 6.6%, that's from the dog and the owner, it grows to more than 210,000. Not enough to retire on, but this is actually an impressive amount of growth given how little you're investing. Why does it grow like this? It's called compound interest. Well, what is that? I will admit that this is a little bit of a confusing idea to get your mind around. I'm going to try to break it down to you as simple as I can, using a layman's definition from Benjamin Franklin. Yes, that Benjamin Franklin. He was a big fan of compound interest, just like Einstein. I'll tell you a little story about that in a minute. He defines compound interest this way. He says, money makes money, and money that makes money makes money. I know it's confusing still, but I want to show you where he gets this by showing you the math on this problem, okay? We'll look at the math on the coffee problem. So what you're doing is you're investing $3 a day. $3 a day times 365 days in a year is 1,095. So that's what goes into the account on year 1. It then grows by 6.6%. That's the investment growth rate. At the end of year 1, you have $1,167.27. In year 2, compound interest kicks in. Okay, so here's what happens. First, you invest another 1,095. That's just what you're committed to doing instead of buying coffee. You're doing that each year. It gets added to what was already in the account. You can see those numbers matched. So that at the beginning of year 2, you have this amount, and then the whole thing grows again by 6.6%. At the end, you have $2,411.58. All the following years look the same. Now, let's think about Benjamin Franklin here, okay? Where is he getting this? He says, money makes money. So you've got some money in your pocket, and it makes money. How did that happen? You invested it. So that's the first part. Then he says, that money that makes money starts to make money. What he means is you're reinvesting it, not taking anything out, including you're reinvesting the interest you already made. So the interest gets reinvested. This is why it's called compound interest, because the interest starts to make interest on itself. So that's what he means, is the interest begins to snowball. And this is what it looks like if you graph it. This is what $3 a day looks like. When you invest it, you can see this upward sloping line. This is the power of compound interest. What starts out really humble in the early years starts to look really impressive the longer you let it go. This is why your faithful financial advisor encourages you to invest as soon as you can, because time is so powerful. This is what it looks like if you max out your IRA, something a bit more realistic. You can see it grows to more than 1.1 million. This is the everyday millionaire. All of us could do this, I'm sure, who are on this call, with just a little bit of careful life planning. Now, I told you that Ben Franklin was a big fan of compound interest, and he demonstrated this with his life. At the end of his life, he gave a gift of $5,000 to the city of Boston and $5,000 to the city of Philadelphia. He put that money into an investment account, and he told Boston and Philly they couldn't touch it for 200 years. Okay, so if you look at the slope of this line at 40 years, you can imagine what it looks like at 200 when it's like really turned up and really, really going. That measly $5,000 has become many tens of millions of dollars, and Philly and Boston are still trying to spend that money to this day. Pretty cool. The reason it works is time is on my side. Yes, it is. Very famous investors here, the Rolling Stones. Here's a quote from Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. Time is such a good friend with investing because of the power of compound interest. All right, last point, and actually my favorite, invest in businesses, not stocks. I have this conviction that many of us have actually lost sight of the true purpose of investing. Investing has become divorced from its original and most basic purpose, which is to supply capital to businesses. Okay? What is investing like today? Investing is about profiting from the market. The market, this abstract idea where you kind of put your money into this big financial thing called the market, and you ride this wave, and you hope that it spits out a better result for you at the end of the line, right? Many of us are not thinking about businesses, and we're not thinking about what businesses we're investing in. We just kind of put our money in and go about our lives. Well, when we have this market view, what happens? Our relationship to investing becomes a relationship of performance only, where when the market's doing well, we're going to feel good. When the market's doing poorly, we're going to feel poorly. And we don't really know where our money's going and what we're involved in. Here's a quote from a professor at DePaul University who describes what it feels like to be an investor. So try this on for size. He says, retirement accounts tend to just go into mutual funds, where as an investor, not only do I not have any idea how the companies that I have stock in are being operated, I don't even know what companies I have stock in. And these investments tend to be run by an elite of managers whose one preoccupation is with profit, increasing the bottom line. Have you ever just thought about your investments and wondered, where's the money coming from? What are the companies I'm owning here? What are the products and services and business activities that are generating the profits, that are funding the returns, that are funding my future? And importantly, how do I feel about all that? Here's an inside look at the industry. This is a famous portfolio manager that I heard speak at a conference a few years back. He was describing his investment process, and I'll never forget it. He said, I pride myself on not knowing what's in our portfolios. kind of an astonishing statement, isn't it? This is a portfolio manager whose job it is to pick the companies for the portfolio that his clients will then own. And he's saying he considers it a point of pride to not have a clue what companies he's choosing. Isn't that weird? Now, why is he saying this? You might have guessed. He's a numbers guy. If he's evaluating a stock and it's got the right numbers and metrics, it's good. It makes it into the portfolio. And he's so disciplined about this, he actually removes the names of the companies from his view so he can just focus on the numbers. Now, on the one hand, I think that's impressive, that level of discipline in his process. On the other hand, haven't we lost something? Haven't we lost sight of the connection between our dollars and the companies we're investing in? Isn't that important? So I want to remind us here at the end that investing is not just a numbers game. It is the act of investing in businesses. You will profit from businesses. This is where the values and ethics of investing come in. Joe is very familiar with this. And I wanted to end on this note because I think it's important that we not just have profit-related questions about our investments, but also some company ownership questions. I want to get you thinking about that. So maybe about the management teams of the companies we own, or how they treat their customers, their employees, their suppliers, the communities they operate in, how they care for creation, and their impact on society. Here are some questions to get you thinking. Would we want to work under the leadership team at that company? Would that be a good thing? How likely would we be to recommend their product or service to a friend or family member, someone we love? Would we want our son or daughter to work at this company? Scale of 1 to 10, 1's a new flavor of gum and 10 is a cure for cancer. How much value does this product bring to humankind? If we walked into a supply center, would we be proud of the quality and working conditions that we saw? What would our reaction be if this company opened an office in our neighborhood, a supply center plant or factory? And does this company's environmental policy and actions leave a better planet for our grandchildren? These are company ownership questions. And if we see investing as just numbers, they make no sense. But if we remember that investing is about investing in businesses, I think these questions make all the sense in the world. I want to leave you with this quote. This is from the portfolio manager at my company. I think he captured really well the importance of this company perspective. This is a long quote, but I like it. He said this: "By investing with Eventide, you will grow in your peace of mind." How do you get peace of mind? Peace of mind is the byproduct of trust, and trust is the byproduct of knowledge. Many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up. On the other hand, if a person knows the business the stock represents, trusts management, and so comes to believe in the company, these declines are not so troubling. That person is a confident investor because history has shown that great businesses not only endure downturns, but emerge even stronger, making these declines perhaps attractive points to invest further. At Eventide, we help investors understand the merits of our portfolio companies so they can better appreciate what they own and thus transcend a mere chart-based financial relationship in investing. They can then have greater confidence and less stress because they're not buying mere paper or derivative, but a portfolio of quality businesses they know and trust. After all, life should not be spent staring at a computer screen watching ticker gyrations, but instead free from needless stress. At Eventide, we strive to help give you that peace so you can spend your time on what matters most. One last time, the timeless truths for investing: keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe and invest in businesses, not stocks. With that, I'm going to welcome Joe back on and maybe we can take some questions.
Yeah, I'm still here. That was really great, Jason. Really appreciate that. Also, everybody that's on this actually joined this webinar with an invitation that was said to be truth, rather than what we usually see in investment advertising, which is making you fearful or chasing greed. So have to say thank you for everybody that came on looking for that. So we're going to, if you could, in the next few minutes, enter any questions you have in the Q&A box down on the bottom. I'll just give you a couple minutes there. And while you do, there's a couple of you that are on audio only might be driving. The phone number here, if you'd like to reach us at Avanti Wealth Management, is 407-331-7330. Love to schedule some time. And we'll go ahead and pick up on the Q&A, but if you'd like to stay on, if you stay on through this, I have a little offer at the end. So let's see. So question in here is, does concentrating the investments add more risk to the portfolio? So I guess they're asking when you're looking at individual companies versus the broad market, you're talking the S&P 500. Would that add risk, or how would that affect return?
Concentrating investment. So yeah, what do you think is being asked there?
I think what he means on that, when you're talking about the broad market doing the 6.6%, and the end, it came in just when you were talking about investing in businesses, not stocks.
Okay.
So I think that's what that means. That's probably going back to the indexing question. Why don't I own everything?
Yeah. I'm having a hard time getting my mind around this one. Do you want to take a crack at it, Joe, and then I can jump on?
Oh yeah. It comes from one of the gurus out there that says just buy the S&P 500, and it's cheap. It's the cheapest thing you can own, and you'll make 12% a year. That's where I think that I'll often hear that type of question come in.
Got it.
I have no investment selection cost. I'm just buying everything.
Yep.
So I think the fallacy in that really starts with the assumption you're going to make 12% a year. On those charts, those big dips, if you followed that advice, put all of your money in at the end of 1999, over the next 3 years, I think you lost 59% of your money. A little more risk than most people would like to take. And almost the identical number if you threw it all into the broad market and bought the inexpensive S&P 500 in 2007, the following 2 years, you lost 60% again. So I think that, I don't think it adds risk. I think active management of some type can mitigate risk. You don't want to own everything all of the time.
Yeah. Just a word on the historical returns there. The chart that I showed with the 6.6% growth constant. So that's with inflation deducted.
Okay.
So the number published there would be a little bit higher if you just threw in the inflation number. Historically, inflation is about 2.5%. Okay. So it'd be a bit higher than that. It's still not 12. The
positive side is doing anything consistently is better than trying to randomly pick. So that might be a better answer for that.
Yeah,
I have another question on here. You must be able to see the slide numbers. Slide 46. Jason, can you give me a quick example of how they do this research on companies?
Yeah, let me see if I can go back.
Not sure what 46 was.
Here we go. Yeah, so what we do is, maybe I'll go back one more slide. This is probably a better way to look at it. So we are a values-based investment manager, which means we hold ourselves to two mandates. The first mandate is generate an attractive rate of return for our investors. We are trying to beat our peers and our benchmarks. We're an active fund manager. So that's mandate one. Most funds will have that mandate. We give ourselves the second mandate, which is we want to make sure that we're profiting from companies that we're really proud to own. And that means considering whether their product or service is good for society, which I think is the purpose of business, to create goods and services for the world, and that they're operating their business with integrity and taking care of all the groups that are shown on this screen: customers, employees, suppliers, communities, the environment, and society. So the way that we do this is, well, number one, we've got a lot of data on this. There's a lot of values-based data that's produced today. So we look at that, but it is a very human process. We are interviewing management teams. We are speaking with people who are operating in that industry and getting their vantage point on the company. There's also a lot of data that you can find on how customers feel about the business. So this would be customer reviews. There's employee reviews of the business. If you're familiar with Glassdoor, employees are rating what it's like to be an employee of that company, what they think of the CEO, et cetera. You can actually, talk to suppliers and find out their feelings there. There's good environmental data. It is a tough job to try to answer these questions well that I showed on the slide 46. That's this one. But this indicates the direction that we're trying to go, which is to say we want to feel good about this investment, not just because it has a good return, but because those returns are good, right? They're coming from good sources. So it is subjective in how we do that, but that's what we're striving to do. So good question there.
Early on, when I started working with Eventide, it was said that some of the original ideas came out of this, looking back at the most admired companies to work for, the Forbes list, best companies to work for. It went back on the values of the companies, how they treated people, and I think all of the studies went back and said they actually outgrew their peer groups. So that's where one of the ideas came from. But I want to go ahead and respect everybody's time here. You can call me or shoot me an email with, there's a couple of questions on there. I'll reach out to a couple of you on those specifically. But we're also offering anybody on the call that would like a portfolio review, a second opinion on their financial plan. If you're already clients, you're in great hands. For those of you that are part of the Avanti family and already an Eventide investor, thank you for investing to make the world rejoice. Sorry. To further the conversation, Jason is going to presenting a second in this series, little webinar called The Power of Investing. I'm kind of a history buff and a nerd on real stories, so I really enjoy this one. That will be in 2 weeks on April 14th at 6 p.m. We'll send everyone an email, send that out tomorrow. But for everybody that's on the webinar that stayed on tonight, we've entered you in a drawing for one of several wonderful Eventide insulated mugs. They actually are really nice. We'll go ahead and have that drawing. So check your email tomorrow to see if you're a winner. And thank you again for being here tonight. Jason, thank you very much.
My pleasure. Thanks, everyone.